Top 5 investment strategies for beginners. Investing can be an excellent way to build wealth and secure a financially stable future. However, the world of investing can be daunting for those just starting out. That's why we've put together these top 5 investment strategies for beginners to help simplify things and guide you on your journey. Before moving forward, if you're new to our channel, don't forget to like and subscribe to our channel for future interesting videos. Understanding your investment goals and risk tolerance. One of the initial steps in our list of the top 5 investment strategies for beginners is to clearly define your investment objectives and assess your risk tolerance. This is pivotal as your investment decisions are largely driven by the goals you want to achieve and the amount of risk you're comfortable with. Are your objectives long-term, like saving for retirement, or are they short-term, such as setting aside money for a home's down payment? The duration of your goals can significantly influence the type of investments you opt for. Long-term goals might afford you the opportunity to consider more volatile investments, while short-term objectives may lead you to more stable, less risky options. Understanding your risk tolerance is equally important. In simple terms, risk tolerance is your capacity to endure potential losses in your investments. For instance, if you're at a younger age, you might be more willing to accept higher levels of risk. The reasoning behind this is that you have ample time to recoup any possible losses that might occur. Conversely, if you're approaching retirement, your risk tolerance may be lower. This may lead you to lean more towards conservative investments that offer stability over high returns. In essence, aligning your investment strategy with your goals and risk tolerance is crucial. Your personal financial objectives and your comfort level with risk should be the compass guiding your investment decisions. By thoroughly understanding these two facets, you're setting a solid foundation for your investment journey. Diversifying your investment portfolio. A practical approach to reduce risk and achieve a balanced investment portfolio is through diversification. This tactic involves allocating your investments across a variety of different financial instruments, industry sectors, and other classifications. The goal behind diversification is to potentially improve the chances of investment return by investing in different areas, each of which would likely respond differently to the same economic event. The concept behind diversification is that it can be risky to put all your eggs in one basket. For example, if you invest all your money in one company's stocks, you're essentially betting everything on the performance of that one company. If that company performs poorly, your entire investment could plummet in value. On the other hand, when you diversify your portfolio, you're spreading out your risk. If one of your investments performs poorly, it may be offset by another one of your investments performing well. This is not to say that diversification completely eliminates risk, but it can certainly help to mitigate it. All types of investments come with a certain level of risk. However, by spreading your investments around, you can better manage the impact of any one investment's performance on your overall portfolio. Remember, not all investments or types of investments perform well under all economic conditions. Some investments may do well during an economic upswing, while others may do better during a downturn. By having a diversified portfolio, you're increasing the chances that at least some of your investments will do well regardless of the economic climate. Diversification, therefore, can be a great way to help smooth out the volatility of your portfolio over time, aiming for a steady rate of return. That said, it's important to keep in mind that it's not just about having a variety of investments, but having a variety that makes sense for your individual investment goals and risk tolerance. Diversifying your portfolio is an ongoing process that requires regular review and adjustment as market conditions change and as you get closer to your investment goals. The power of compound interest and regular investing. When it comes to making your money work for you, two concepts reign supreme: the power of compound interest and the value of regular investing. Often referred to as the eighth wonder of the world by Albert Einstein, compound interest has the potential to exponentially grow your money over time. This occurs when the interest you earn from your investments is reinvested, thus creating a cycle where you earn interest on your interest. The beauty of compound interest lies in its ability to amplify growth over the long term, leading to significant returns on your initial investment. Alongside understanding compound interest, regular investing plays a vital role in maximizing your investment potential. It's a simple yet effective strategy which involves consistently contributing a certain amount towards your investments, irrespective of the amount. Even small, consistent investments can accumulate into a substantial sum over time, particularly due to the effects of compounding. In other words, regular investments help you to steadily increase your capital, which then compounds over time, further amplifying your total returns. Therefore, the combination of compound interest and regular investing can prove to be a powerful force in growing your wealth. These strategies are effective because they leverage the fundamental principle of time. The more time your money has to grow and compound, the larger the potential returns. This is why it's crucial to start investing early and consistently. It allows compound interest more time to work its magic, and your regular investments continuously add to the capital that's compounding. Investing in low-cost index funds. As you navigate your investment journey, a key strategy to consider involves engaging with low-cost index funds. These types of investments replicate the performance of a particular financial market index, such as the S&P 500. Low-cost index funds have gained popularity for their affordability and their passive management style. What does this mean? Essentially, rather than a fund manager actively picking and choosing which stocks or assets to buy and sell, an index fund simply mirrors the composition of its target index. This passive style of management can significantly reduce management fees and expenses, hence why these funds are often referred to as low cost. Why does this matter for beginners? The allure of low-cost index funds lies in their ability to deliver broad market exposure, offering diversification benefits. This approach helps reduce the risk associated with investing in individual stocks. It's a way to own a small portion of every company in the index, spreading out the risk. However, the most compelling reason to consider low-cost index funds is their historical performance. Over the long run, studies have shown that these index funds tend to outperform most actively managed funds. This performance trend is, in part, because of the lower fees they charge. High fees can erode investment returns over time, which is less of a concern with low-cost index funds. Don't be misled though, the term low cost does not equate to low returns. In fact, the opposite is often true. Index funds offer a method of achieving the average market return, which has historically been quite favorable. And remember, in investing, achieving consistent, average returns over a long period can lead to substantial wealth accumulation, thanks to the power of compound interest. Utilizing dollar cost averaging. Dollar cost averaging, DCA, serves as the final strategy in our collection of the top 5 investment strategies for beginners. This systematic approach involves a consistent investment of a specified sum of money into the same investment vehicle, be it a fund or individual stock, at regular intervals, irrespective of its price. When the cost of the chosen investment is high, your fixed investment amount will purchase less of that investment. Conversely, when prices dip, that same fixed amount will fetch you a greater quantity. Over an extended period, this strategy works to diminish the potential detrimental effect of market volatility on the overall cost of your investments. Imagine it this way: with TTA, you're playing a long game, smoothing out the highs and lows in the price of an investment. Instead of trying to time the market or make predictions about when prices will be at their lowest or highest, a notoriously difficult and risky endeavor, TTA allows you to stick to a predetermined investment plan regardless of market conditions. This takes a lot of the guesswork and stress out of investing and allows you to focus on building wealth gradually over time. It's important to note that while TTA can be a very effective strategy, especially for beginners, it's not a guarantee against loss. No investment strategy is. It's always possible that the investment you've chosen could decline in value. However, by spreading out your investments over time, you're not putting all your money in at a peak price point, which could reduce potential losses. Keep in mind, DCA isn't just a one-time setup and forget kind of strategy. In conclusion, dollar cost averaging is a tried and true investment method that takes advantage of market fluctuations to potentially reduce the average cost of your investments over time. It's a worthy inclusion in any beginner's investment toolbox. Remember, the key to successful investing isn't about making big wins quickly. It's about steady, disciplined investing. And dollar cost averaging fits perfectly within that framework. If you enjoyed from this video, don't forget to like and subscribe to our channel. Thanks for watching.